Good morning, everyone, and thanks for joining us today for the third quarter's update of the Global Cautious Fund. My name is Doug Nicol. I'm an investment analyst on the Best of Breed team here at Nedgroup Investments. And today I'm joined by Tony Cousins. He's the CEO and CIO of Perfect International, who are based out of London, and they are the managers of the Nedgroup Investments Global Cautious Fund. A few items to mention before we get started. If you've dialed in through Teams, please make a note of the Q&A, and we'll be happy to take any questions that you have from the call later on the call. I'd also just like to draw your attention to the fact that this will be recorded and it will be made available via various media platforms, including YouTube and other major podcast platforms. So if you wish to share this with your clients or listen to this again in your own time, please refer to those websites. A bit of quick insights and context before I hand over to Tony. Perfect have a very impressive track record of managing an asset allocation strategy for over 26 years now, and their investment strategy has three very simple objectives. It's to preserve investors' capital, to beat a cash benchmark, and to deliver this with low volatility in returns, with a key emphasis on downside protection. Perfect have executed this strategy by effectively investing in a portfolio of high-quality sovereign bonds and global equities with a relentless focus on capital protection and liquidity. And we can touch on this later in the Q&A with Tony, where we can discuss why he thinks sovereign bonds are still a good option for having these sovereign bonds in his portfolio. But we believe here at Nedgroup Investments that Perfect offer an ideal alternative to traditional offshore cash deposits and fixed income funds in the current low interest rate environment facing global investors. And this strategy has been implemented by a very stable and experienced investment team through a number of global market cycles, and they've managed to deliver investors very robust investment returns while still continuing to outperform a cash benchmark. After a strong performance during this year's challenging market environment, Tony is going to take us through the fund's performance during Q3 this year, and that'll be great. So just turning our attention to the second slide. We can see that the major asset performers in the market this year have been gold. Again, government bonds have delivered impressive returns, and this is obviously a key component of our fund, and Tony can talk through this later in the fund. Obviously, big detractors in the markets this year have been Brent crude and REIT markets, which Brent crude has been a factor in the portfolio, but not certainly to the extent that we've seen these types of drawdowns. The fund has also managed to avoid global REITs, and we don't hold any direct exposure today. Where we have not had any exposure has been global high yield bonds, and also global bonds, which have performed quite well this year. But again, Tony can talk later to why we don't hold them in the fund. But without further comment on the market, I'll hand over to Tony, who's going to take us through the fund's performance this year. Tony, over to you.
Thanks, Doug. Good morning to everybody who's dialed in today. If we can move to slide 3, this looks at the performance over the quarter. Total fund delivered 2.24%, so that is above benchmark. And we then drill down into where that came from. All the contributions were positive, with the exception of cash and currency hedging. We have a policy at Perfect of managing overseas unhedged foreign exposure within a 0 to 45% of total fund risk parameter. So if we didn't do any hedging, we would exceed that, and risk parameters are very important. You must stay within them. So in order to achieve that, we hedge the most expensive currency relative to the US dollar, which is the Australian dollar. As the Australian dollar went up, that is what generates the negative currency hedging effect, and that is a mirror image of a positive return within non-US dollar bonds and non-US dollar equities from the Australian equities. So that's an opportunity loss as opposed to a real loss. In terms of performance against the index, or perhaps we should move to the highlights of performance on slide 4 now. Clearly a positive absolute return above the benchmark. That's what we are paid to do. So that's what we need to achieve. The unhedged exposure, which is right at the top of our range of 45%, was a significant contributor as the US dollar weakened. The equity portfolio was also positively contributing. On the debit side, I've talked already about the hedge on the Australian dollar, which we have to do to manage the risk of the portfolio. But our equities did not quite keep pace, both in the US and overseas, due to the strength of the market rally. We run an equity portfolio which is characterized by quality and value. It is currently very defensive, so when the market rallies as strongly as it did during the third quarter, our stocks tend to lag. The other side of that is when markets go through turmoil, as they did in the first quarter, our stocks preserve capital and are very, very defensive in that environment. Moving on to slide 5 now, we look at the equity weighting. Obviously, within the cautious fund, we are constrained at a maximum of 40%. We believe within our opportunity set, equities will be the best performing asset class in the very long term. It's what investors get paid for the risk of investing in equities. However, history shows that there are many times when equities are a very poor investment, and that is all about starting point. If you buy equities when they are very overvalued, they will subsequently give you a very poor return. If you buy them when they're very cheap, they will subsequently give you a very good return. So the essence of this strategy is to lean into equities more as they get cheaper, and we see on this slide precisely how that happened this year. In the first quarter, as equities fell very sharply in response to the COVID-19 crisis, we increased the equity weighting. As equities have rallied strongly in early June, we reduced the equity weighting again. We put the money into overseas equities rather than US equities because they were offering significantly better value. Between the increase and the reduction, equities had gone up 20%, but dividends on those equities had actually fallen by 22%. So essentially markets in that period became 40% more expensive. And this is one of our concerns today, that equities have rallied very strongly, but the underlying earnings and dividend base has actually deteriorated. I'll come on to show you that. Just one quick slide to put it in very, very long-term perspective. This is the slide 6, which is the cyclically adjusted price-earnings ratio of the US equity market, often called the Shiller PE, after its author. This attempts to take the cycle out of measuring earnings, looking at 10-year rolling periods of earnings, and this remains at an elevated level. Fell sharply in quarter 1, but the equity rally has taken this back up to an elevated level, really only being exceeded in 1929 and the dot-com bubble of the late 90s. Now, moving on to the next slide, slide 7, we see what has happened this year to earnings on the world index. Obviously, as the market fell in the first quarter, the PE, price-earnings ratio, on the market also fell. As the market has rallied really back to where it was at the beginning of the year, the PE has obviously risen. But what has happened during this time is the earnings base has fallen significantly. So what we end up with is that a market which was valued at about 21 times earnings at the turn of the year is now valued at 25 times earnings. So the market is now significantly more expensive than it was when we started 2020. When we look at dividends on slide 8, exactly the same is true. We see here that the market started the year giving, this is the world market, a dividend yield of 2.3%. That increased to 3% with the market fall, but has since fallen sharply, firstly because the market has gone up, but also because dividends have been cut. Dividends have fallen precipitously around the world. The world index dividends have fallen by 17% year to date. Now, that has not been shared equally amongst the regions. Europe has been hit much harder. The Eurozone dividends have fallen 25%, the UK have fallen 32%, the US have only fallen 10%. By far the best place has been Asia, and Asia including Japan and excluding Japan, where the decline is in single digits. So the effects on earnings and dividends base have not been equal around the world. Some other slides, on slide 9, we look at Warren Buffett's favorite measure of value within markets. That's the market capitalization to GDP. Here we see over the last 20 years, we were only ever higher than where we are today in the dot-com boom. And this is at a very elevated level. And so markets are clearly discounting a strong recovery from the COVID-19 crisis and are really being very optimistic about the future. When we look at actually what has happened on the right-hand side of slide 9, we see this is just one measure of economic activity. We see a collapse in the first year, and fortunately, there has been a rebound. But just look at the size of that rebound. It has only been about a third of the fall that we have seen. So markets, economies, economic activity is still very suppressed, yet the market is anticipating a full recovery. Now, looking at some policy response to what we've seen, we have seen a massive coordinated, and this is on slide 10 now, massive coordinated fiscal and monetary stimulus in the first half of the year. These are figures which have rarely been seen before, double-digit percentages of GDP in terms of fiscal stimulus to the economy. We see the US, the UK, Australia, Japan around about 12%. Germany is an eye-watering 18% of GDP, and this has been matched by huge increases in money printing. Over the last 10 years prior to COVID, we'd seen about $15 trillion. We've now seen about $19 trillion of money printed since the great financial crisis. So this is quantitative easing moving into a new era of really direct monetization of central bank issuance. Now, this was absolutely necessary. What governments are doing here is trying to build a bridge from the pre-COVID world to the post-COVID world and support economies, support wages, support employment until we can emerge from this crisis. The problem is that we are now effectively 8 months into this crisis, and the bridge is running out of road. What is needed is further fiscal stimulus, particularly in the US, where the existing programs are just simply dropping off. But because of the political impasse, we are not seeing that happening. And we are really quite concerned that the US really does need further fiscal stimulus. It can't just be done through more money printing. It has to be done through targeted spending from the government. So that is one of our key concerns, and we can talk about that further in the Q&A. Looking at currency movements, we see what the US dollar has done today. I won't sort of talk in great detail about individual currencies, but what we will say, and one of the advantages for this portfolio, is it is investing out of a very overvalued currency, and this is shown on as an example on slide 12, sterling against the US dollar. The US dollar is, along with the Australian dollar, about the most expensive currency on the planet. The methodology we use for arriving at that conclusion is called purchasing power parity. I won't go into the technical nature of that, but it's essentially a measure of export competitiveness. And if your currency remains too overvalued for too long, your current account, trade account will suffer because your exports will be priced out of the market. So that's why it works. You see the blue line is the currency rate. The green line is the calculation of fair value. The shading either side is 25% either side of the green line, which is a measure of quite extreme valuation. And as we saw, as we can see, the US dollar had actually gone outside that 25% level. Now it's come down, but it still has a significant way to go. And this is why we have at the upper end of our risk limit exposure to overseas unhedged foreign currencies. And we achieve that both in the equity portfolio and the fixed income portfolio. Just sort of finishing off on where the portfolio is positioned. We have 72% in bonds, 25% in equities, 3% in cash. Within the bonds, we are favoring non-US dollar bonds in order to achieve that overseas exposure. And similarly, within the equity portfolio, we are favoring non-US equities because they are very significantly cheaper than US equities. And to drill down further, within that non-US equity portion, we are very much favoring the economies and the markets of Asia, excluding Japan. Within global equity markets, firstly, these markets are cheaper than others in terms of simple valuations, but also in terms of economic growth. This is an area which is going to outshine both the US and Europe significantly. They just have much better structural factors in terms of labor force growth, demographics, productivity growth, lower debt penetration, and higher savings ratios. These are things that Western markets and Western economies used to have, but really those have been fading away in recent years. Asia still has them. The trend growth rate in Asia is the same as it was in the US in 1960. So I think we can look to Asia for continued positive developments looking out over the next decade. I think I've come to the end of my sort of formal speaking spot, but I'm very happy to answer any questions you have. So just in summary, we maintain a cautious stance within this portfolio as befits its name. The quarter beat the benchmark, positive rates of return, but we do have some concerns looking forward for what equities can deliver. And with that, I'll hand back to you, Doug.
Thank you very much, Tony. I just understand that the first slide that I showed on the market performance wasn't clear when I did my introduction, so I'll leave this on in the background while I ask Tony his first question. Tony, there are a few slides which I can bring up shortly, which show the real yields on sovereign debt and how those have come down below zero with the effective monetary easing that's been implemented by central banks around the world. And I guess the question is twofold. There's a lot of sovereign bonds in this portfolio, 72%. We tend to allocate these to higher rated countries, such as Canada, US, UK, and Australia. So I guess the question is, why continue to hold these even at a zero real yield when they're providing a zero real yield? And then the second question is, why are these bonds more attractive to you in the strategy compared to typical corporate and high yield credit bonds?
Okay, well, a number of things there, Doug. Firstly, let's look at the positives. Holding non-US dollar bonds enables us to take advantage of the expected decline in the US dollar over time. So there will be a forex gain on those bonds over time. So that's one reason to hold them. Another issue is that these bonds are extremely short duration. Now, I don't want to get technical here, but duration is a measure of the price sensitivity of a bond to any given change in yield. Obviously, if yields go up, prices go down. And I couldn't agree with you more about real yields. They are exceptionally low, and therefore they need to rise. And we believe in time they will rise. And if you own any significant duration within the portfolio, you will lose a lot of money. And obviously, that's a fairly catastrophic outcome. So that's why we maintain a very short duration. The essence of this strategy is that it's unconstrained and it requires liquidity. When the facts change, as they did in the first quarter, we need to have liquid assets that we can sell in order to take up those opportunities. And the characteristics of sovereign bonds is they are highly liquid. They're probably one of the most liquid securities you can find. And so that is why we don't go into corporates or agencies, because when there is market turmoil, as we saw in the first quarter, the liquidity just evaporates. And in the corporate bond market, for example, in the US, there was only one buyer, and that was the Federal Reserve, which really had no option but to step up to the plate to stop an explosion in credit spreads. I think we also have concerns on credit quality as a result of the economic outlook that we see. The U.S. economy now has an all-time high in terms of corporate debt to GDP, very significantly surpassing the previous peaks of 2000 and 2008. Around about 60% of investment-grade corporate bonds in the US are in the lowest category of investment grade, which is BBB. And any further economic deterioration is going to lead to downgrades. And this is one of our great concerns for the corporate bond market. If a constituency within the investment arena cannot hold them anymore. Insurance companies are required to hold investment grade bonds. So if bonds cease to be investment grade, they have to sell them. And there, you could see a tsunami of divestment within this area. And if you own these bonds, the door will not be big enough for everybody to get out of. So, again, we're taking a very conservative, cautious approach. And what we are looking for, as we found in the first quarter, is an opportunity to increase the equity weighting, and we will be sourcing that money from sovereign bonds that we hold.
Thanks, Tony. And I think that's a couple of key points that you mentioned there with the strategy, and that I guess there are four drivers of return here. There's your currency, there's your asset allocation, there's your stock selection, and then there's your equities and bond allocation. So they are not just only sovereign real yields that are driving the portfolio return, which has been demonstrated in that second table that we showed our investors, which showed that more recently the correction in currency markets, where we've seen a devaluation of the dollar, that's led to significant gains for investors who've been patient. And this was obviously coupled with Tony's rotation of the portfolio into higher levels of equity during pretty challenging markets in March. So I think that's a good important point to make. But Tony, as we start to look at second waves of COVID hitting developed markets, we're seeing economies close down in London, Dublin, and in France as well. And I guess the stimulus that has been provided both by monetary and government, or the central banks, and by governments, has effectively been to keep people alive more than grow the economy. But the implications are quite clear. You know, we're going to have higher levels of debt at the end of this crisis. How do you see governments dealing with these levels of debt? And is inflation becoming a risk that you guys are starting to worry about? And how are you positioning your portfolio to deal with this risk?
Okay, yeah, very good point, Doug. There's no inflation at the moment. What the world economy is seeing is a deflationary demand shock, which is, if anything, getting worse because of the second wave that you point out. However, longer term, inflation certainly becomes a risk. If you look at the expansion, the growth in monetary aggregates, and I don't want to get too technical again, but inflation is a monetary phenomenon. That growth has been very, very high, and that sort of portends 2 years away growth in inflation. Now, against this, we look at what the policy response will be, and we've had speeches from Jerome Powell and Christine Lagarde at the Fed and the ECB to say that they will allow the economy to run hot. That means they will not respond aggressively to any increasing inflationary pressures that they see, and because they are very concerned about crushing the economy by monetary tightening. So I think what we are looking for here is a future where inflation becomes more of a problem. And that's to be expected, because this is what you do when you're in a debt hole. You try and inflate your way out of it in nominal terms. So make if you can grow the economy in nominal terms, partly through inflation, the debt to GDP will come down. So this is the game. The problem is if you own those bonds with any length of duration, that will result in capital loss. So it's very, very important to preserve capital by keeping duration very low. We're not seeing that yet, but this is clearly a risk further down the line. History tells us, and any listeners who remember the 70s will see this, that whilst equities theoretically should be a good inflation hedge because they are a nominal asset, in the early stages of rising inflation and rising inflationary expectations, they perform very poorly. And that's what the history of inflation bounce has shown us. And it's only when inflation peaks that equities start to perform. One asset class we continually monitor is index-linked bonds. Unfortunately, they give you a sharp, real negative yield, so they're not offering a lot of value, but they will give inflation protection. Cash is the other thing, a short duration, which gives inflation protection. What you don't want to be anywhere near is a long duration conventional bond. So just as an example of how the mathematics works here, if you hold a 30-year bond today, the duration is about 27, 28. What that means is that if yields go up just 1%, you will lose 25% of your money. And that obviously is a disastrous outcome. So inflation isn't good unless you're a borrower, and the governments are all borrowers. So they see this as an easy way out in the long term. But inflation also causes lots of problems. I think the idea that they will know then to tighten is very, very dubious.
And Tony, just a closing remark. There's been a lot of, certainly in our fund range, we've seen quite a significant rise in investors taking money offshore from South Africa. And a number of people on the call are advising clients around taking these decisions. What words of wisdom or advice would you give to such a person who's looking to take money offshore? And what are some of the factors that they should be looking at and thinking quite hard about?
Sure, yeah. I wouldn't for a minute try to speak to our listeners about the South African economy and its prospects. I think you folks know a lot more about that than I do. But I think we have seen long-term depreciation of the rand, and in any portfolio, diversification is very important. So getting some of the money into overseas investments is just a sensible idea. But I think we need to look at the prospects for capital gains on the mainstream asset classes and employ a lot of caution. Equities are expensive. Bonds are also expensive at the longer duration curve. So I think in terms of risk exposure in overseas markets, clients should be very cautious right now. We are a value and quality manager. We only buy quality liquid assets, and we are very happy to take risk in those assets when you're being compensated for that risk, and that's by being offered securities which offer good value. And that is not today, I'm afraid. Better value came back in the first quarter, but the decline in earnings and dividends and the rise in markets have taken that value away. So I think it is time right now to be cautious, and part of my job is to sort of lower expectations following such a strong quarter as quarter three.
Thank you, Tony. I believe that's all we have time left for Q&A today, unfortunately. Thank you again to all of our listeners who've taken their time away from their desks to come and listen to Tony talk. Thank you to you, Tony, for coming in and speaking to us. And I hope that everyone has found this conversation quite useful and informative. For those callers who have any further questions regarding the Nedgroup Investments Global Cautious Fund, please do get in touch with your Nedgroup Investments representative who will be happy to assist. And of course, just to remind you again that this recording will be available on YouTube and on various podcast platforms to listen again. Tomorrow, we finish the third quarter feedbacks on all of our global range. We'll be receiving an update from Jeremy Lang on the performance of the Global Diversified Equity Fund, which I believe is the top performing Nedgroup Investments fund in our range this year. But before that, I'd just like to say thanks again, and from myself and the Nedgroup team, as well as Tony, goodbye and take care and enjoy the rest of your day. Thank you very much. Goodbye.